Dave Ramsey's investment philosophy departs wildly from traditional investment models backed by reams of academic studies and mountains of historical data. Regardless of your age, proximity to retirement, or financial profile, Dave Ramsey recommends the exact same investment allocation. What exactly is that investment allocation? On Ramsey's website, we read, Dave divides his mutual fund investments equally between 4 types of funds: growth and income, growth, aggressive growth, and international. This lowers your investment risk because now you're invested in hundreds of different companies all over the world in a whole bunch of different industries. In other words, you're not putting all your eggs in one basket, close quote. Okay, so Dave has essentially adopted a philosophy in which he recommends you put all of your chips in the stock market. He, as am I, is an unflinching believer in the power of capital markets. But the question becomes, even if you too are a believer in capital markets, is Ramsey's recommendation the very best allocation for your situation? It's simple and paint by the numbers to be sure, but is it the very best way to invest your retirement savings? And by the very best, I mean, does it give you the greatest return for the lowest amount of risk? That is, after all, the name of the game when it comes to investing. The Money Guy Show recently did a deep dive on this and compared Ramsey's recommended allocation to the S&P 500. What they found was that when the overall market was performing well, the two portfolios performed similarly. In fact, the best 3-month, 1-year, and 3-year returns were nearly identical between the Ramsey portfolio and the S&P 500. However, the worst periods were much worse for the Ramsey portfolio than the S&P 500. This is because the Ramsey portfolio is inherently more risky than the S&P 500 portfolio, but there are no surplus returns to justify all that extra risk. In fact, the S&P 500 outperformed Ramsey's preferred allocation over the last 1-year, 3-year, 5-year, and 10-year time periods. The other glaring irregularity in Ramsey's standard portfolio recommendation is that it contains no bonds. No matter your age, financial makeup, or proximity to retirement, you get the same investment allocation, and that allocation does not include bonds. You could be 5 years from retirement or 5 years into retirement, and bonds are not part of the Ramsey equation. Now, there are mountains of data to support incorporating bonds into a balanced investment portfolio as you age. What's the old adage? Take your age, subtract it from 100, and that's how much you should have in bonds. This is a pretty tried and true approach when it comes to investing. In fact, so-called target date funds will automatically shift money from stocks to bonds as you age, out of mind, out of sight. And clearly there's good data that supports this approach. Yet, Ramsey isn't buying any of it. It's 100% stocks or bust. Let's listen to Dave Ramsey himself to learn why he holds bonds in such contempt.
If you take the bond market and plot it on a graph as it goes up and goes down, and you take the stock market and plot it on a graph as it goes up and it goes down, those mountains and those valleys, those peaks and those valleys on that graph indicate the volatility of that market over time. And if you took, say, 50 years or 75 years of the stock market, you could see how the stock market goes up and down over a period of years. And you could look at the bond market and see how it goes up and down over a period of years. Now, something that is safer would be less volatile. If it is so safe that we move an entire population as it ages out of stocks and into bonds, you would think it would be a lot less volatile. And the truth is, if you take those two graphs and you lay them over the top of each other, there's not a lot of difference. Bonds are less volatile than stocks, but not much. And they don't perform as well. The stock market has outperformed the bond market over an extended period of time. And the difference in the two, honestly, isn't spit as far as volatility.
Okay, so Dave doesn't like bonds because they don't perform as well as stocks while still tending to be somewhat volatile. Not nearly as volatile as stocks, but volatile nonetheless. Well, if what Dave is saying about bonds is true, then vindication should be just a Google search away. But when we scratch just below the surface on Dave's claims, we find that the data tell a completely different story. The Money Guy Show did another comparison from 2000 through the end of 2021, showing how the S&P 500 portfolio, which is less risky and more productive than Dave's portfolio, would have compared against a portfolio made up of 60% stocks and 40% bonds. Take a look at how those two portfolios would have fared over that time frame. You'll notice that the 60-40 portfolio just isn't as sexy. The highs just weren't as high as the pure stock alternative, and this is clearly what fascinates Ramsey about the all-stock alternative. However, what Ramsey clearly fails to appreciate is what happens during the lows. As you can see, the bond portfolio's lows weren't anywhere close to the lows you would have experienced in the pure stock alternative. And when you look at how these two portfolios line up at the end of the 22-year time frame, you'll see that with the 60-40 portfolio, you took less risk but got a greater return. In fact, you would have earned just over $60,000 more in your 60-40 portfolio. But here's the larger issue. If you are relying on your investments to support you in your golden years, one bad year in the market can completely derail your retirement. It exposes you to huge amounts of what is known as sequence of return risk. This is the risk associated with the order in which you experience returns in your investment portfolio in the early years of retirement. If you're forced to liquidate stock investments to pay for your lifestyle following a down year in the market or several down years in the market, like we saw from 2000 to 2002, it could send your portfolio into a death spiral from which it never recovers. Now, one other observation, Dave Ramsey's stock-only approach to investing could be perfectly justified if he didn't unequivocally recommend against guaranteed lifetime income annuities. With annuities, you hand over a portion of your stock market portfolio to an insurance company in exchange for a stream of income that's guaranteed to last so long as you're on this side of the grass. And with a bit of planning, this annuity, along with your Social Security and perhaps a company pension, can completely cover your living expenses in retirement. And with your lifestyle expenses covered by your guaranteed lifetime income, you can now earmark your stock market portfolio for any discretionary needs you have during your retirement journey. Maybe you have to replace your roof, or you want to take your grandchildren on that Disney cruise. Any extra expenses in retirement. Now, if your living expenses are guaranteed, you can now afford to take more risk in the stock market portion of your portfolio. In fact, all that guaranteed lifetime income gives you a permission slip to take more risk in the market. In fact, you can allocate 100% of your investments to stocks. No bonds necessary. Now, after taking Dave Ramsey to task for not recommending bonds, how dare I recommend you remove bonds from your portfolio in retirement? Well, if your lifestyle needs are covered by your guaranteed income, you won't be constrained to spend down your stock portfolio following a down year in the market. You have the luxury of waiting until it recovers before you take further distributions. And by allocating 100% of your investment allocation to stocks, you dramatically increase the likelihood that your portfolio will support your discretionary expenses through life expectancy. In summary, Dave Ramsey's one-size-fits-all anti-bond investment approach is contradicted by years and years of academic studies and empirical data. When you allocate 100% of your retirement savings to the stock market, particularly in retirement, you expose yourself to huge amounts of sequence of return risk and increase the likelihood that stock portfolio could go into a death spiral from which it never recovers. That means you risk running out of money years in advance of life expectancy. All this begs the question, why does Dave Ramsey continually make investment recommendations that fly in the face of convention? As I mentioned in all my other Dave Ramsey related videos, he doesn't have the luxury of nuance. If he's going to play financial guru to millions of Americans, he has to dispense one-size-fits-all, paint-by-the-number investment advice that can be boiled down to just a few sound bites. And the moment financial gurus start saying those fateful words, well, it depends on your situation, then you cede ground to independent financial advisors who specialize in creating customized financial plans that cater to your specific financial needs. And before you know it, Dave Ramsey is out of a job. Folks, in the next 10 years, I'm looking to put 100,000 Americans on the road to the 0% tax bracket. If you'd like some help getting on the road to a tax-free retirement, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is Dave McKnight. I look forward to seeing you on the next video.